Hey everyone, I hope you're all doing well out there. This is your September market review. So the reason that I put these videos together for my clients each month is to give you guys the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to just give you the straightforward information about what's going on in the stock market and the economy, and then how that boils down to affecting your investments. So stocks for the month of September were down across the board, continuing this skid from mid-August through really the end of September here. Stocks for the S&P 500 were down 4% in September. It marked them down as much as 25% as of the end of September. I'm shooting this video October the 5th, so the first couple days of the new quarter in October here, Monday and Tuesday, both days the market was up close to 2.5% or over 2.5%, which marked the best start to a quarter since April of 2009. So that puts that in a little bit in perspective, because if you remember what was happening in March and April of 2009, that was the very bottom of the great financial crisis, and in the last 20 years, the best buying opportunity that the stock market has had. And that's just the start of a quarter, but kind of an interesting sign because of how oversold the market is by a lot of different indicators here going in through the end of September. Not to say that it's due to just rally the rest of the year, but not surprisingly seeing a little bit of a rebound to start out the new quarter here. So bonds were also down for the quarter as well. They're down as much as 16% as of the end of the quarter. And what I'm using to track that is the aggregate bond index, which is a composite of not just government bonds, but corporate bonds, both short and long-term bonds. That's the most widely tracked. The aggregate bond index is the most widely tracked index for bond pricing. So one of the reasons why within client portfolios I don't use bonds, because of what bonds have done this year, although they are becoming a lot more attractive with interest rates going up, especially on the shorter end of the interest rate curve for shorter term bonds, with yields being closer to 4% now for not just 2-year bonds, but treasury bonds, but your 1-year treasury bonds are inching closer to that as well, in the mid 3% range for treasury bonds, which that's a guaranteed rate of return because it's backed by the full faith of the federal government. So one of the things I thought was interesting that I wanted to bring up in my first chart, and for those of you that haven't watched these before, what I do is I use a lot of charts and graphs to depict, really within the investment world, what is a very difficult concept to grasp a lot of times when we're talking about investments and money and the economy as a whole. I like using graphs and charts because they depict this whole topic of investments and the economy in a lot better way than I feel I can articulate and that most people can articulate. So the first chart that I have is a chart of returns in the S&P 500. The chart, actually, the data that I have goes way back through 1928. But what I'm going to do, just for ease sake of looking at this, what I wanted to highlight are the time frames where the market is down 20+%, and then looking at the following year, because we are in the fourth quarter right now. Just short 3 months from now, we're going to be in 2023. So looking ahead on where we're at, because from an investment management standpoint, that's where I'm always looking. Looking in the rear view mirror doesn't really do us a lot of good, because it's more about where we're going and not where we came from. So looking ahead, there's only a handful of times over the last 90 years where stocks have been down 20+%. So if we look at some of them, the last one besides this year was 2008, where the following year the market was up in 2009 23%. That was actually after starting the year down pretty big in January, February, and March that year before turning a corner. Then you'd have to go all the way back through 2002, where the market was down 23%. Following year, stocks were up 26%. And then after that, we have to go all the way back through the mid 70s. In 1974, stocks were down 29%, and the following year up 31%. Going all the way back prior, there was in the midst of the Great Depression, there was 1937, start of World War II. The market was down 38%. Following year, stocks up 25%, and really in the heart of the Great Depression was the only time frame where there wasn't a rebound the following year, where in 1930 we had 28% followed by a 47% drop the following year, and then 15% the year after that. So keep in mind, the Great Depression was by far and away the worst time frame from an economic standpoint that our country's seen in the last 150 years. In the modern economy, and this is since the Federal Reserve was created in the early 1900s, by far the worst time frame for the economy in that way. One of those instances that, there's a lot of people in the media that will try to compare, current events to, big market bubbles and depressions and be over the top about it. And, those people, super candidly are smoking crack because they're either just talking out their ass and they don't know what they're talking about, or they're just trying to sell something that, generally speaking, is either trying to either sell more ads to get more people to watch their shows, which one of the reasons I create this, or, there's some sort of political angle that they're coming at from or talking from, because that's where a lot of that hardcore sort of propaganda stuff comes from. So I'm not comparing that because it's just not a relevant sort of time frame to look at in the Great Depression. So, but using even those time frames, that's the only time frame in the last 100 years where we've had a down year after a 20% drop. So bright side there. So that was one of the charts I wanted to bring up because I thought that was an interesting piece, especially being where we're at right now in the market, down about 22%. The other chart that I came across that I thought was a good one to bring up is, and the reason I'm going, talking about it from this standpoint is that right now within the market, a lot of people, there's, especially since stocks are down as much as they are in the time frame that you've worked with me as a client, or for anybody that's watching this that isn't a client of mine, if you've invested in the last decade, you haven't seen any sort of drop at this level for this long. So COVID was actually worse. So for those of you that are feeling very skittish about where your portfolios are at right now, you blinked when COVID happened because you were probably more worried about everything that was going on with the world and COVID and all of that. But COVID, stocks were down 35%. So, and that happened in 5 weeks. So this has happened over the course of 9 months, which exacerbates it a little bit because it's in the media more. You see it on more statements. It's slow, it's aggravating, and it's painful to watch. But this is a normal bear market. This is what happens in the economy. Stocks don't always go straight up. And this is the reason that you get paid more to invest in stocks over the long haul. So emphasis there is the long haul. So the next chart that I have here is going over the Investors Opportunity Index. This is a chart that what it is just inverting the S&P 500 rate of return, because if you notice, we're down about 22% here. Or this is up about 22%, which just means that if we're flipping this around, and I'm trying to give you a different lens to look at this with, this is actually a good thing if you, A, are more conservative, B, you have more money in your portfolio, or C, you aren't taking money from your portfolio right now, or if you are taking money from it, it's from a more conservative portion within your portfolio. So the Investor Opportunity Index is just a way to look at the market where you're flipping the script on how traditionally you'd be looking at a index being down if we're just looking at it in a chart form. So this just shows kind of the opportunity that's there and that's available right now, and really the opportunity that as an investor, if you have money sitting in cash right now, the opportunity that's sitting in front of you to get some of that money working for you versus it just sitting in a bank not making anything. Because even as interest rates go up, banks are not going to be incentivized by giving higher and higher rates on savings, money markets, CDs, because they don't need more deposits. They already have a ton of deposits, so they don't need to attract more money to their banks. In most cases, you'll see those special CDs with new banks or credit unions that are offering special CD rates. That's short-lived though, because as those banks or credit unions get off the ground, they're going to cut those rates to be closer to where the rest of the market's at, which is very low as far as CD rates go. So if you're looking for short-term things to put money in that you want it to be guaranteed, reach out and talk to me, because there's things like I-bonds, which currently right now offer a 9.6% rate, which is adjusted based on inflation. That'll actually reset here in October based on previous inflation. There's also treasury bonds and treasury bills that have higher rates now because of where interest rates have gone to and the overall bond market and where the bond market has moved as well. So if you have those kinds of short-term needs, reach out to me. Be happy to talk with you a little bit more specific about that versus just leaving money sitting in your bank account where it's not just sitting there stagnant, not making anything. Remember, it's always losing money to inflation. If it's not at least minimally keeping pace with inflation, it's actually losing money. So even though if you have $50,000 sitting in your bank account, you still see $50,000 and maybe a couple pennies there in 3 months from now when the bank pays you that measly interest. Really, you've actually lost a whole lot more than that, because inflation is still very high. Over the last year, it's still above 8%, meaning that if you had cash in there over the last year and you didn't have it invested in any way and it wasn't making any interest, you actually lost 8% in purchasing power on that money, which the purpose of money is to buy stuff eventually. It's not just to feel warm and fuzzy that it's in an account. So remember that. Next chart I have goes into inflation a little bit more. I thought it was a fun chart to look at, but something just tying into inflation. This is a chart going over grocery prices from a year earlier. So again, tying in that inflation aspect. This was an article I had seen that was highlighting cost of butter. Changes from a year earlier. You can see that in the yellow there. Butter prices have gone up almost 25% in the last year. All grocery prices over the last year have gone up 13.5%. Eggs, the most extreme increase, going up 40%. So if you're crushing those eggs, obviously that's costing you a little bit more, maybe another 40 cents per dozen. So, but that definitely adds up if you're eating enough of them. It's interesting to see though that all items, and this is 8.3%, that's the inflation rate. And if you're looking at that, most groceries on here are above that 8.3%. So obviously groceries as a whole, it's something everybody needs because you need to eat. So maybe you can cut out the snacks that are up 16%, lean out a little bit, and tighten the belt as the economy's taking it to us here. So last chart I have is a little bit more of a timely chart because of where we're at in the year with the midterms coming up and the elections. I get a lot of people that reach out to me talking about politics all the time and how, when Trump was in office, how erratic he is and how it's driving, the economy into the ground. And then I'd have people calling me how great the economy is and how stocks are doing really well, and Trump is the best thing that happened since sliced bread. Now I have the same thing with President Biden in office. So it's interesting, and the reason that I bring this up is not just because of this chart, but I'll tie in something that's in this email as well that I think all of you should take a look at as a blog post that I put. If you click out to the main page where you got the email, where you clicked on this at, you'll see underneath there I have politics and investing, and I wrote a blog post here a couple months ago talking very specifically about how little politics really mean in the long term, and especially talking Democrat versus Republican. History's proven it time in, time out. It does not matter who is in office. I know that's stunning and shocking for some people out there that really doesn't matter. but it's the truth, it's facts, it's literally in the numbers. I can't make it up because there's statistics. Another statistic here, this chart that we're looking at, is a 1-year performance after the midterm election. And going back over the last 80 years through the beginning of World War II, and that includes even the year in 1946 where there weren't elections. So keep that in mind that there was 1 year skipped. But there has not been a negative 1-year performance for the S&P 500 in the last 80 years following midterm elections. And obviously, again, that's swung both Democrat and Republican. So you can pick out the years and it's going to be pretty average across the board. The Democrat held, Congress is the same as a Republican held Congress over time. The biggest thing here I want you to take away from this is that investing, not just staying invested, but if you're looking to invest more or you'd like to become more aggressive or do things like a Roth IRA conversion, which I know I've talked with a number of you about out there, great time to do it. Obviously, just from a seasonal standpoint with elections happening, this is a good time to do it because it gets rid of some of that uncertainty that elections bring to the stock market as a whole and the economy as a whole. So those are the charts I had here for this month. If you have any questions or would like to contact me to go over your specific portfolio, don't hesitate, call, text, email. I'll be more than happy to set up some time to talk with you more in depth about your specific portfolio. And I appreciate you all taking the time to check me out. Until next time.